Welcome. Today's Thursday, March 9th. I'm Jeff Huge, Chief Investment Officer at JWH Investment Partners, and I'm the founder and editor of Alpha Insights. And this is your Daily Five. Daily Five is the show where we go through kind of the five most important charts that have our attention. But to begin, I'd like to just kind of remind everybody that we just published our newsletter last Saturday, the 4th. And so it's still pretty fresh, hot off the press. For those who aren't familiar with our work, we do publish an investment newsletter. It's free to subscribe, and it's delivered into your email box about the first Saturday of each month. The newsletter is affectionately titled Huge Insights, the Big Picture. And in that newsletter, we really kind of focus on the key macro factors that are affecting, the economy, the markets, and our positioning, really. And for those who want more, we do also offer an optional upgrade to paid version for as little as $10 a month, which includes our monthly market forecast and our positioning recommendations. As well, paid subscribers also receive a weekly email from us. It's our Alpha Insights Idea Generator Lab publication. That's usually an institutional only publication. It details our top actionable trade idea for any given week. And it also provides some updated market commentary. So that comes out every Wednesday. So if you're interested in getting a deeper dive on what we're thinking about, go to Substack, hugeinsights.substack.com, or you can go to our website, jwhinvestment.com, or you can find it on Twitter. Our Twitter handle's @alpha_insights. Any of those places will give you access to the newsletter, and give it a whirl. It might be worth your time. So with that, let's check out chart number one. This is a rerun from last week, but it's dramatically different at the same time. We talked about this in the sense that the Fed funds terminal rate had been in motion last week, or I guess 2 weeks ago. We indicated that it had kind of pushed out to around the 5.25, 5.50 range. In the last few days, there has been another major recalculation of the probability of a higher terminal Fed funds rate. That's now moved from the 5.25, 5.50 range out to the 5.50, 5.75 range. And it now appears that any cut this year is off the table. So those of you who aren't familiar with these charts, they come from the CME Group's FedWatch tool, and that uses Fed funds futures to calculate the probability of a future rate hike based on the market's positioning along the futures curve. You might also be aware of the fact that several Federal Reserve governors have been vocally indicating or intimating that 6% is a possibility. And that's a level that was predicted by JP Morgan CEO Jamie Dimon about a year ago. I also think it's important that in addition, there's now a much higher probability that the Fed will raise rates by 50 basis points at the March 22nd meeting. The lower chart here gives a sense of where we are. It's about a 78.5% probability that we'll get a 50 basis point hike at the March 22nd meeting. Now, 2 weeks ago when we were on the show, it was the exact opposite. It was a 78% or maybe a 73% probability that we'd get a 25 basis point hike. And so, the market has kind of flip-flopped on that dramatically. And so, I think one of the really important things to think about is that we've got a lot of data coming up here. We've got, NFP report on Friday. We've got a CPI and PPI report coming out next week. So it's going to be somewhat data dependent. And I think unless we get cooler than expected numbers in those reports, we can probably expect a 50 basis point hike. The market's usually right about these things. And the other thing I'd point out is that the 3-10 Treasury yield curve spread is currently at the steepest inversion on record. It is already begun to reverse now from its lows of minus 133 basis points to about minus 81 basis points. Usually when the curve begins to steepen, that is an indicator that recession is right in front of us. And so we would not discount the probability of a recession in the next 1 to 3 months. We should start to see data points that support that. We would also not expect the 10-year Treasury yields remain subdued if Fed funds start to ascend toward that 6% level. So, we kind of are walking a tightrope here between inflation and recession, right? Because the Fed's reacting to historical data, but the markets may be reacting to expectations of future data. We'll see how that plays out. Let's look at chart number 2. Valuation matters. One of the ways that, and we've been talking about why we need to be concerned about stocks at this point, and one of the reasons is we think valuation is exceedingly high. And one of the ways to get some perspective on where we are in the valuation debate is to compare the current valuation of the stock market to a risk-free alternative like the 6-month Treasury bill. And this chart comes courtesy of David Rosenberg of Rosenberg Research. Rosie illustrates in this chart the forward 12-month earnings yield, which is currently around 5.4%. That's for the S&P 500, and that's the blue line. And what it really is simply the reciprocal of the PE ratio. So we're now comparing the earnings price ratio, basically, and that's 5.4%. And we're comparing that to the yield on the 6-month T-bill, which is right around 5.3%. So as the caption states, the yield on the 6-month bill is now on the verge of surpassing the earnings yield for stocks. That would suggest that stocks are quite rich when compared to the risk-free option. Conversely, if we set the Wayback Machine to March of 2020, we can see that stocks were trading at their nadir, but the earnings yield at that point was 700 basis points higher than the 6-month T-bill rate. And so that spread of around 700 basis points was indicative of how cheap the market was. And here we are at a 10 basis point spread. We can see how rich we are, relatively speaking. It's very rare when the T-bill rate exceeds the earnings yield on equities, and it usually doesn't last very long. Let's look at chart number 3. Chart number 3 examines earnings revisions. And this is another thing that kind of dovetails with the valuation issue, because valuation is based on earnings largely. And what's been happening over, really the last couple of quarters, since at least the end of Q3 2022, consensus S&P earnings estimates have been in a free fall. And according to S&P Capital IQ, the street's now looking for 2023 op earnings of just $218.68. That's as of about a week and a half ago. When you compare that to their 2022 estimate of $219.38, that's a year-over-year decline. Now, 2022 earnings estimates are not solidified yet. There's still a few companies yet to report, but that's pretty close to where they're going to come in. So we are now looking at an expectation for a year-over-year decline of around 0.5% or 1%. Now, recall that just 1 year ago, the consensus was actually forecasting 2022 and 2023 earnings to grow at over 10%. I think it was around 10.5%. And it now looks like 2022's growth rate is going to finish the year at about half the original estimate, while 2023 is expected to be negative. So all hope has shifted and focused on 2024. 2024, not surprisingly, has a consensus forecast of a very healthy 13.4% year-over-year S&P operating earnings growth. The problem here is Wall Street has no idea what the market is going to do in terms of earnings in 2024, just like they had no idea a year ago what they were going to do in 2023 or 2022 for that matter. Wall Street's expectations are totally predicated on what's now known as the no landing fantasy, whereby the Fed will be successful in its efforts to vanquish inflation through its aggressive rate cycle, but revenue growth will somehow accelerate. Yes. And they all lived happily ever after, right? We'll see how this turns out. Our suspicion is it will not turn out the way the street is expecting. Let's look at chart number 4. A little perspective on the market here. This is another model that we've developed over the years. We call it our long-term Fibonacci trend model. Here we're looking at the S&P 500, which has been really range bound since last May. It's been traversing around the Fibonacci 610-day moving average. That's the blue line in kind of the center of this range. And it has been contained on the upside by the Fibonacci 377-day moving average in green, and on the downside by the Fibonacci 987-day moving average in red. Now, we did penetrate that lower bound, but we'll talk about that in a second. The August weekly high of SPX 4280, we're calling that key resistance. A weekly close above that would be very concerning for the bears. The October weekly closing low of 3583 is key support. A weekly close below that level, I think, would be very, very disturbing for the bulls. So the question is this bullish or bearish? From a pure technical perspective, it is neither. The market has not spoken yet. What we believe to be the case is that there is a bias to the downside here, and we've articulated it using the Elliott Wave principle, showing that the peak in January of 2022 was the end of cycle wave 5, and since that time, we've seen the market fall in 5 waves to complete primary wave 1 down, rally in 3 waves into the August 16th high to complete primary wave 2 up, and that we are in the early subdivisions of primary wave 3 down, which we believe could carry all the way down to, say, 2,700 for starters, which would basically just intersect with a line that connects the lows going all the way back into November or so of 2021. From that, we see the initial decline into the October low, which penetrated that lower boundary of this trading range, that Fibonacci 987 day moving average. That, we believe, was an indication directionally of where the market wants to go. That we have labeled as intermediate wave 1 of primary wave 3, and the 3-wave advance that ended on February 2nd looks like the intermediate wave 2 top. Since that time, we've seen a 5-wave decline, which we're calling minor wave 1 down, and a 3-wave advance that now looks like it could be minor wave 2. If this is correct, then we are looking at the market on the precipice of a third wave decline. Decisive break, however, in either direction, above or below this range, will indicate, I think, the next directional move for the market. Our work favors a break to the downside, and we'll see how that plays out. Let's take a look at a shorter term view. Chart number 5 digs into the daily trading machinations since the August 16th high. In other words, we've seen that 5-wave decline at intermediate degree, hitting its lows on October 13th. Since that time, a clear 3-wave advance that we count as ABC. The December 13th high was the end of the A wave. The December 22nd low marked the bottom of the B wave, and then the rally into the February 2nd high peaked in terms of the C wave, and that ended intermediate wave 2. You can see 5 waves down, terminated on March 2nd, and we are in the process of either having completed minor wave 2 up, or there might be a little bit more work to do. We'll see. If in fact we take out the March 6th high, we think that what we've now labeled as minor wave 2 might just be the A wave of minor wave 2, and that this initial decline that we've seen subsequently could be the B wave. However, if we take out the lows of March 2nd, that will confirm our current preferred count and suggest that we are in the process of heading significantly lower in minor wave 3 of intermediate wave 3 of primary wave 3, which ultimately should be confirmed upon the break of the December 22nd low. That will confirm our view. A sustained move back above S&P 4230 would call this view into question. 4230 is kind of where the open chart gap resides, dating back to kind of that post-August period, and also around the 88.6% retracement, which is another Fibonacci sequence. So with that, that kind of illustrates our short-term views. If you'd like to follow up with this, you can certainly check out our website at jwhinvestment.com, or follow us on Twitter at alpha_insights. We're also on Substack at hugeinsights.substack.com. With that, I want to thank you very much for your time and wish you the best of luck trading.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.